I'm Alex Matthew, and you're watching Stocks to Watch on Bloomberg Quint. We've got an interesting lineup to discuss today, and I'm joined by Mayuresh Doshi. Thanks so much for joining me today, Mayuresh.
Thank
And
you.
right off the bat, starting with Interglobe Aviation, based on the cost control measures that were announced in the run-up to the earnings display, we knew that it was going to be a bit of a tough quarter for them. And right enough, the biggest loss ever in a quarter was reported by Interglobe. How did the numbers stack up for you, and how do you view the QIP announcement or the fundraising announcement in that context?
Morning, Alex. Thanks for having me on your show. So yes, I think if you look at the overall context in terms of how the numbers have played out amidst the lockdown and the slow and steady recovery in terms of flights starting off domestically, I think the yields that Indigo posted around 4.2, 4.3, obviously because of the fare bans imposed by the Ministry of Civil Aviation, I think that did aid a lot of the yield improvement that we've probably seen. If you look at the more granular aspects, Alex, the cash burn probably for all these aviation companies continues. So Indigo had a cash burn of almost 40 odd crores amid the crisis. It's now come down to 30 odd crores. And again, the measures taken in terms of employee cards, the leave extensions that they've probably taken, and other initiatives including leasing and so on and so forth. What happens also in terms of the planes under operation, the A320neos, 274 odd planes under operation in terms of the fleet capacity that they've got. But what happens in terms of the entire usage and how utilization levels, specifically in terms of load factors, stack up are going to be extremely critical going forward. If you look at the available per seat kilometers, they are expected to come back very, very slowly. And even at this point of time, considering the pre-COVID levels, you're still looking at a 40 to 50% kind of level that can come through. So therefore, I think it's going to be a very, very slow and gradual recovery. The measures adopted to reduce the cash burn probably there on the books at this point of time. The liquidity is pretty reasonable even at this point of time. So I think the additional liquidity that they are probably targeting, I think that might be some kind of a stack up in terms of shoring up balance sheet strength. But the cash that they've probably got on their books in excess of 80,000 crores, I think that can be a savior in times like these. You also have to have one more context very quickly. I think what has happened with SpiceJet in terms of the negative net worth reported at 1550 odd crores, they've got far lesser aircraft at this point of time. And both these carriers are now looking at cargo, which is a highly lucrative segment, specifically in pandemic conditions like this. So Indigo has converted 10 aircrafts into that. And maybe this is one line that they'll probably also look at to optimize both costs and also augment their revenues. So yeah, I think measures taken up to probably strengthen balance sheets, but the pain structurally might still continue for the next few quarters for aviation companies.
Very quickly, Mayuresh, in one line, what is the verdict though? Would you hold on to Interglobe and say that you're pushing expectations of significant earnings recovery to next year?
So if you look at the probability cases, I think the probability is that the earnings recovery will happen only by next year. And they stack up comparatively better to its other listed peers, SpiceJet. So in that sense, with the cash on their books relatively better to its peer, expectations of competition gains over its competitor, considering the weaker balance sheet that its competitor has. And the third element in terms of some improvement over next year's numbers, I think that can be some premise if investors are still holding on to this.
Understood. All right. Now, the second stock that we have is Titan Company. Of course, we were expecting, again, a weak quarter basis, what we've seen in terms of the lockdowns and the kind of availability of stores. Of course, that has ramped up by the end of June. They said 83% of stores were open. And the management commentary was positive for the jewelry segment, Mayuresh, in that they're saying that they have market share gains and various other statements that were positively interpreted. But how would you rate the numbers, and what is your expectation going forward as to what is key to watch for Titan?
So very quickly, Alex, I think the numbers were expected to be very, very soft because the lockdown pressures apparently played out in terms of stores being closed, very, very gradual reopening of stores in the month of May. And that's what was largely expected, both from the jewelry and the watches business as well. But what the commentary said post the numbers is that July saw some element in terms of pickup of sales as store openings have now got normalized. What they're also seeing in terms of the pre-wedding buying that is expected to come through in the second half. I think that buying has already started happening gradually for Titan. And they are gaining market share gains, specifically from the unorganized players. So clearly putting, I think the structural story still remains on track in terms of how the gold demand will play out, albeit with the prices that we probably see will be a dampener. But a large element in terms of the recoup, in terms of the high value studded sales, which has come down to 18%, a very, very healthy balance sheet at this point of time. And again, I think they're only 10%, Alex, of the overall jewelry market. So I think there is a huge amount of gains that can be done. So I think structurally, the story remains very, very positive. Numbers a little bit below expectations in terms of what the street believed could have been delivered. But again, the management commentary is pointing that the second half might be better. So yeah, I think among the large cap names, this is one stock where I think the faith and the confidence structurally over a longer term might just stay.
That's the verdict on Titan. The last company, of course, is a major name in the banking space, ICICI Bank, joining some of its peers, Mayuresh, in raising funds. So the QIP announcement that came in yesterday, kind of par for the course, right? But more importantly, the reason why they're raising the funds, should an investor now anticipate that there will be a deterioration, a significant deterioration going forward in asset quality? Is that something that you're looking forward to?
So I think gradually, if you look at the numbers which got posted, the moratoriums actually have come down quite significantly. So I think the aspect that the street was worried about, whether those moratoriums will stay put and whether that stickiness will continue, I think that has largely come off on a quarter-on-quarter basis. The second element, obviously, is that the retail advances are expected to grow at a very, very healthy pace. Now, all these banks have upgraded their underwriting practices, and with that respect, I think the corporate lending as well as selective in terms of the unsecured retail lending, I think that is going to be the focus areas for these banks, including ICICI Bank. The other parameters are very much on track. So if you look at the excess provisioning that is still being done on their balance sheet, PCR in excess of 76, 77 odd percent, the cost to income ratio expected to remain extremely stable around that 40-41% odd mark. NIMs expected to be remaining stable even with the MCLR adjustments, and deposit growth gradually looks relatively stronger from the larger private sector ones. So NIMs around 3.6, 3.7%. And the capital raise that they're probably doing will be accretive to the book over a longer period of time. In the case of Titan, as they are making significant gains into the unorganized space, there might be market share gains that these larger private sector banks can very well do in periods like this and even post-pandemic. So yeah, I think ROEs have been stifled to a certain extent because of the pre-COVID conditions of the general economic slowdown. But I think they should bounce back pretty sharply as the economy recoups over the next few quarters. So it should be value accretive, this capital raise. So I see no issues related to the long-term structural story of ICICI.
Very quickly, Mayuresh, so I would think that's a positive comment for you for ICICI Bank. But very quickly, the Hexaware technology, and this is over and above the three stocks that we've discussed today, the delisting announcement, or rather the resolution to voluntarily delist has gotten approval from shareholders. Is that a positive for you, or what are you watching for?
No, so yeah, I think what has happened, and it has been passed by the shareholders. So I think I've not seen the granularity very strictly, Alex, but I will get back to you.
Fair enough. Understood. Thanks so much, Mayuresh, for joining us on this leg of Stocks to Watch. It's been a pleasure as always.
Thank you so much.
And to you, dear viewers.